Welcome to our deep dive into creative real estate financing. We're going to uncover some seriously cool strategies that go way beyond those traditional bank loans.
You'd be surprised just how many deals actually happen outside those conventional financing routes.
Right. Like it's a whole other world out there.
It is. That's where things get really innovative.
I love that. And to guide us through this exciting world, we've got the wisdom of real estate experts Bill Ham, Gino Barbaro, Jake Stenziano,
Pace Morby?
and Chuck Sutherland.
Yeah, they've not only built some impressive portfolios themselves, but have helped countless others break into the market too.
That's what we like to hear.
What's interesting is how all these experts, despite their different approaches, kind of emphasize that real estate is ultimately about problem solving.
Problem solving, so it's not just about the money.
Not just about the money.
Okay, I'm intrigued. Can you give me an example of what that looks like?
Well, think about it like almost every property out there is already owned, right? So instead of fixating on like how much money you have, the key is finding those motivated sellers with problems that you can solve.
Oh, that's a good point.
It becomes about more than just the money.
So you're not just a buyer, you're like a solution provider.
Exactly.
That's a powerful shift in perspective.
It is. And Bill Ham actually illustrates this perfectly. With a story from his own experience, he significantly boosted his net worth by taking on this distressed 27-unit apartment complex.
Okay.
But here's the kicker. He did it using private money, not a traditional bank loan.
Wait, private money, is that like loans from family and friends? Or is that something else?
It can be, but it also includes loans from like individual investors or companies that specialize in real estate.
Okay.
The takeaway is that he found a way to make the deal work without having all the cash himself.
Oh, that's fascinating. Okay, so where does someone even begin with this whole creative financing thing? What are some of the most common strategies?
Well, seller financing is a fantastic starting point.
Okay.
This is where the seller of the property actually becomes the lender.
So instead of going to a bank for a mortgage, you get it from the seller themselves. I wouldn't think sellers would be too keen on that.
You might be surprised. Remember those motivated sellers we talked about?
Right.
Maybe they need a fast sale or are having trouble finding a traditional buyer. For them, seller financing can be the perfect solution.
Okay.
They even get that added benefit of earning interest income over time.
That's a good point. I didn't even think about that, so now I'm starting to see the appeal for both sides.
Yeah.
I've heard this phrase, give on price, take on terms, thrown around.
Mm-hmm.
How does that apply to seller financing?
It's a trade-off. You might offer a slightly higher price than you would with a bank loan, but in exchange, you negotiate those favorable financing terms from the seller.
Got it.
Think lower interest rate, smaller down payment, longer repayment period.
Okay, so it's about finding that sweet spot that benefits everyone.
Yeah.
Are there any potential downsides to seller financing that I should be aware of?
It's essential to be cautious of subject to deals.
Mm-hmm.
This is where you essentially take over the seller's existing mortgage without officially buying the property.
Ooh, that sounds risky.
Our experts, Ham, Barbaro, and Stenziano, all strongly advise against this due to those significant legal and financial risks involved.
Okay, so if I'm understanding correctly, seller financing generally a solid approach, but subject to is a no-go.
Exactly. With seller financing, you have a legally binding agreement that protects both parties.
Right.
Subject to is much murkier and can leave you vulnerable.
Okay, noted. I'll steer clear of those subject to situations.
Good idea.
What if you need help coming up with a down payment, even with seller financing?
That's where partnerships come into play.
Okay.
We're talking about equity partners and debt partners.
Oh, right, yeah.
Two different types.
Equity partners are the ones who share in the ownership and the profits, right?
Precisely.
Okay.
Let's say you find a killer deal, but the bank requires a 20% down payment.
Right.
An equity partner could contribute that down payment in exchange for a share of the property's ownership and any future profits.
That makes sense. So what about these debt partners? How do they fit into the picture?
Think of debt partners as more traditional lenders, but instead of a bank, it's an individual or company providing that loan.
Okay.
They typically get paid back with interest. Their loan is secured by the property.
So with a debt partner, you're not giving up any ownership, you're just repaying a loan.
Exactly.
That sounds a little bit less intimidating, especially when you're starting out.
It definitely can be. And here's a great tip from Ham, Barbaro, and Stenziano. Start networking and building relationships with potential partners before you even find a deal.
Oh, that's a great point.
Having those connections in place can make all the difference when the right opportunity comes along.
It shows you're serious and ready to move quickly when you've already laid that groundwork.
Exactly.
So we've got seller financing, we've got partnerships, any other creative financing strategies we should have in our toolkit.
Absolutely. Master lease options, or MLOs, is where things get particularly interesting.
Ooh, MLOs. I'm all ears. What makes them so special?
With an MLO, you lease a property with the option to buy it later at a price that you agree on up front.
Okay.
You're essentially controlling the property without needing bank financing or a big down payment right away.
So it's like having your cake and eating it too. You get to experience the property before committing to buying it outright.
That's one way to look at it.
Yeah.
MLOs give you time to improve the property, maybe do some renovations or find tenants.
Oh, that's good.
It helps you build that track record and potentially increase the property's value. Plus, it gives you time to secure that traditional loan if you decide to purchase later.
Wow, so much flexibility with MLOs. It's like a try before you buy for real estate. But where do you even find properties open to these creative arrangements? Are there certain types of properties or sellers to look for?
You're on the hunt for what we call distressed assets.
Okay.
These are properties that have problems
Okay.
that make those sellers more willing to consider creative financing.
So are we talking rundown buildings, fixer-uppers?
Distress comes in many forms, not just physical deterioration.
Ah.
It could be high vacancy rates, tenant problems, or a seller needing to liquidate assets quickly due to personal circumstances.
So it's about recognizing those situations where a seller might be more open to alternative solutions. What are some practical ways to find these hidden gems?
Networking is always key,
Okay.
but you can also build relationships with real estate agents who specialize in distressed properties.
Okay.
Attending auctions and scouring those online listings for properties that have been on the market for a while
Oh, good tip.
can also unearth some great opportunities.
So it's about being proactive and thinking it outside the box.
It is.
What are some specific examples of distress signals that would make me want to take a closer look?
Imagine a property with a higher than average vacancy rate, a history of code violations, or even evidence of deferred maintenance.
Oh, yeah.
Those are all clues that the seller might be motivated to explore those alternative financing options.
Okay, that makes sense. So far, we've mainly focused on the financial and strategic aspects of creative financing. But is there a human element to all of this?
Absolutely, and that's where Pace Morby's insights come in.
Okay.
He emphasizes understanding why people buy and sell, going beyond just the numbers.
Oh, that's interesting. So he's looking at the emotional motivations behind the transactions.
Exactly. He often tells a story about helping a seller who is deeply attached to her property and needed a solution that a traditional cash offer just couldn't provide.
Oh.
It was about finding that win-win that addressed her specific needs and concerns.
So it's about recognizing that there's a story behind every deal, and sometimes creativity is needed to bridge that gap between the buyer and the seller.
Precisely. Morby firmly believes that seemingly impossible deals can be unlocked with the right approach and that willingness to think differently.
Oh, I love that.
He encourages us to look beyond the obvious and explore those solutions that might not be immediately apparent.
Okay, I'm starting to see how powerful this human-centered approach can be.
Yeah,
And it kind of reminds me of Chuck Sutherland, who seems to have a similar philosophy.
you're spot on. Chuck's guiding principle is creating net benefits for everyone
Yeah.
involved in the deal.
I like that.
He believes in shifting from an adversarial negotiation to a collaborative problem-solving approach.
So it's about moving away from that win-lose mentality and finding solutions that benefit all parties involved.
Exactly.
Do you have any specific examples of how this principle plays out in real estate deals?
Chuck often shares a story about negotiating a seller finance deal that initially seemed impossible.
Okay.
By truly understanding the seller's motivations and finding creative ways to address their concerns, he was able to structure a deal that allowed both the buyer and the seller to achieve their goals.
That's incredible.
It wasn't about one side winning and the other losing. It was about finding that win-win sweet spot.
It sounds like he's a master at bridging the gap between seemingly conflicting interests.
He is.
But with all this talk about creative financing, are there any cautions we should keep in mind? What about due diligence?
Due diligence is absolutely critical.
Okay.
It goes beyond just inspecting that physical property.
Right.
You need to thoroughly review seller documents, financial records, leases, contracts, any other relevant paperwork.
So it's not just about kicking the tires, it's about digging deep into the financials and legalities of the deal.
Precisely. Remember, we're talking about a significant investment. You don't want to get caught off guard by hidden problems or unexpected expenses down the road.
Right.
Think of due diligence as your safety net, protecting you from those costly mistakes.
What are some red flags I should be looking for during the due diligence process? What are some things that would make me reconsider a deal, even if it seemed promising at first?
One major red flag is discrepancies in the seller's information.
Oh, okay.
If the numbers don't add up, or if the seller's hesitant to provide documentation, that's a sign to proceed with extreme caution. You also want to pay close attention to the property's financial history.
Okay.
Is the income consistent? Are there any outstanding liens or judgments? Thoroughly reviewing these details can save you from major headaches down the road.
So due diligence is about more than just checking boxes.
Right.
It's about connecting the dots and making sure that the story the seller's telling aligns with the facts.
Exactly.
And here's a crucial point. Due diligence isn't a solo mission. Don't hesitate to consult with legal professionals to make sure you're complying with all those applicable regulations.
Right.
Having a lawyer on your side can provide invaluable peace of mind and help you navigate any legal complexities that might arise.
Definitely.
That's a great point. Sometimes it's best to call in the experts to make sure everything's in order.
Absolutely.
So let's say I've done my due diligence, everything checks out, and I'm ready to make an offer.
Okay.
What are some key things to keep in mind when crafting a compelling offer that will get the seller's attention?
Remember, you're not just presenting a number. You're offering a solution to the seller's problem.
Right.
Your offer should be clear, concise, and tailored to their specific needs and motivations.
So it's about tailoring your offer to the seller's unique situation.
Yes.
What are some practical tips for structuring an offer that stands out from the crowd?
Highlight those benefits to the seller.
Okay.
If you're proposing seller financing, emphasize that steady stream of interest payments they'll receive.
Okay.
If you're willing to take on a property as is, emphasize how that relieves them of the burden of making repairs.
Right.
It's about framing your offer in a way that resonates with their priorities.
So it's about finding those points of alignment and demonstrating that you understand their needs.
Exactly.
What about negotiating the terms of the offer? Any insider tips on how to approach those conversations effectively?
Do your research on comparable properties in the area.
Okay.
This gives you a solid basis for your offer and shows the seller you're serious and informed. Building rapport with the seller and their agent is also crucial.
Okay.
It's not about being pushy. It's about finding that common ground and establishing trust.
So it's about approaching the negotiation as a collaborative process rather than a battle.
Precisely. Remember, a successful negotiation isn't about one side winning and the other losing.
Right.
It's about finding that win-win scenario where everyone walks away feeling good about the deal.
That makes a lot of sense. Are there any other creative financing strategies we haven't covered yet that you think our listeners would be interested in learning about?
Absolutely. Land trusts are often used alongside these other techniques and can offer some unique benefits.
Land trusts. Okay, I'm not familiar with those.
Essentially, a land trust is a legal agreement where you, the beneficiary, own the rights to a property, but the title is held by a trustee.
Okay, so you benefit from the property, but someone else is the owner on paper. What's the advantage of that?
There's several reasons people use land trusts. Privacy is a big one.
Yep.
Your name doesn't appear on public records.
That's right. Which can be appealing for various reasons.
Right.
It can also offer asset protection.
Okay.
So if you face personal lawsuits, assets held in a land trust are generally shielded from creditors.
That's interesting. It sounds like an extra layer of protection for your investments.
It is.
Are there any downsides to using a land trust?
Setting up a land trust can be complex, and it requires legal expertise.
Okay.
So it's crucial to work with an attorney who specializes in this area to ensure everything's done correctly.
Right. You don't want to mess around with those kinds of legal matters without proper guidance.
You do not.
What about resources for those who want to explore creative financing further? Are there any communities or networks that can provide support and guidance?
Private lending networks are becoming increasingly popular.
Okay.
But communities of individuals or companies who lend money specifically for real estate deals.
Oh, interesting.
They can be a great alternative to those traditional banks, especially when you're looking for that flexibility and quick funding. So they're specifically geared towards real estate investors, which sounds promising.
They are.
Where can I find these networks? Are they like exclusive clubs or something?
Not at all. Online platforms are popping up, connecting borrowers and lenders who match their criteria.
Oh, that's cool.
Real estate investment clubs and industry events are also great places to network and make connections.
So it's about expanding your circle and tapping into those communities where people are already actively involved in creative financing.
Yeah.
What should I look for when evaluating a private lending network? Are there any red flags to watch out for?
Definitely do your homework.
Okay.
Vet the network's reputation, research their lending terms, understand their fees and procedures before committing.
Right.
Transparency is key.
Yeah.
If a network is hesitant to provide detailed information about their operations, that's a sign to proceed cautiously.
Okay, so it's similar to due diligence on a property. Research, verify, don't be afraid to ask questions. What about crafting an offer letter that will grab a seller's attention when using creative financing? Are there any special considerations?
Your offer letter is your chance to make a strong first impression.
Okay.
It should be clear, concise, and highlight those benefits to the seller.
Right.
Emphasize how your offer solves their problems and why it's a win-win scenario.
Got it.
Clearly state the purchase price, the financing terms you propose, and any contingencies that need to be met.
So it's about laying everything out in a way that's easy to understand and appealing to the seller's motivations.
Exactly. And don't forget to showcase your credibility.
Okay.
Briefly mention your experience, your financial stability, and any other factors demonstrating your ability to close the deal.
It's like building a case for why you're the ideal buyer for their property.
That's a great way to put it, and always keep it professional.
Okay.
Avoid using jargon or overly aggressive language that could alienate the seller.
It's about fostering a sense of collaboration and mutual benefit.
It is.
We've covered so much ground already. What about exit strategies? How do those play into creative financing?
Having a solid exit strategy is crucial.
Right.
With creative financing, you often have multiple options to consider.
Okay.
One common approach is the buy, rehab, refinance, rent strategy, often shortened to BRRR.
BRRR. I love a good acronym.
Me too.
Can you break it down for me? What are the key steps involved?
It's about leveraging those strategic renovations to create a cash flowing asset.
Okay.
You buy a property that needs some work, renovate it to increase its value, refinance it based on its improved condition, and then rent it out for passive income.
Okay.
The goal is to pull out most, if not all, of your initial investment through that refinance, freeing up your capital to repeat the process with another property.
So it's like a snowball effect. You start with one property and then the momentum builds from there.
Exactly.
I imagine finding the right lender is crucial for this to work.
Absolutely. Building relationships with lenders who understand BRRR investing is a must. They can see the value you've created through those strategic renovations.
It's about having a lender who's on the same page as you, who gets the vision. Once the refinance is done, what's the final step in the BRRR process?
That's the fun part, finding good tenants and starting to generate that passive income.
So it's not just about flipping properties, it's about building long-term wealth through rental income.
Precisely.
BRRR is a long game.
It is.
It's a way to build a sustainable portfolio that generates cash flow for years to come.
That's right.
But before you jump headfirst into BRRR, it's essential to understand the potential pitfalls,
Absolutely.
right? Every strategy has its challenges.
Everyone.
What are some common mistakes BRRR investors make?
Underestimating renovation costs or timelines is a big one.
Oh, yeah.
Another is overestimating the property's after repair value, which can lead to challenges with the refinance.
Okay.
And of course, choosing the wrong property in the first place can derail that entire strategy.
So it's about careful planning, research, and knowing what to look for in a property.
It is.
It sounds like BRRR is more than just a technique. It's a whole mindset.
That's a great way to put it. BRRR requires patience, discipline, and a solid understanding of the real estate market. But the rewards can be significant for those who approach it strategically.
This deep dive has given me so much to think about. It's not just about the specific techniques. It's about expanding my perspective and embracing these unconventional approaches. That's what's so cool about this.
Yeah.
It's like there's a whole world out there that we didn't even know existed.
There is, and that's what I love about creative real estate financing.
Yeah.
It's about unlocking those possibilities that those traditional methods might miss.
Yeah.
It's about challenging those assumptions and forging your own path to success.
I'm feeling inspired and empowered to get creative with my real estate investing.
That's wonderful to hear.
Thank you for sharing your expertise and insights. I feel like we're just scratching the surface here.
We are, but that's the exciting part. There's so much more to explore and discover in the world of creative financing.
Absolutely.
Remember, the real estate world is full of opportunities for those who are willing to think differently and take action.
I love that. Thank you so much for joining us on this deep dive.
It's been my pleasure.
And to our listeners, stay tuned for part 2, where we'll dive even deeper into specific techniques, real-world examples, and that mindset needed to succeed in this exciting world.
Welcome back to our deep dive into creative real estate financing.
I'm excited for part 2, ready to keep learning.
Awesome. Let's jump right in. Let's explore another fascinating technique that often raises eyebrows. Subject to deals.
Right, we touched on those briefly before.
Yeah.
Subject to is where you take over the seller's mortgage without actually buying the property, correct?
Exactly. You step into the seller's shoes, making those mortgage payments, but not officially owning the property.
I'm still a bit fuzzy on why a seller would even go for this. It seems risky for them.
It is risky.
Yeah.
Which is why subject to requires extreme caution. However, for sellers facing foreclosure or desperate to unload a property quickly,
Right.
a subject to arrangement can be appealing.
Okay.
It lets them essentially walk away without further damaging their credit.
So it's like a potential lifeline in those tough situations.
It can be.
But if I were the buyer, what red flag should I watch for?
A desperate seller is one red flag.
Oh, okay.
They might be hiding property problems or undisclosed listings.
not good.
Another red flag is an existing mortgage with just terrible terms, like a super high interest rate or a looming balloon payment.
Yikes. I would not want to inherit that.
No.
So subject to deals are best left to experienced investors who can navigate those complexities.
Generally, yes. It's not for the faint of heart. You need a solid understanding of real estate law and a healthy tolerance for risk.
Noted. What about those master lease agreements you mentioned earlier?
Yeah.
How do those fit into the creative financing landscape?
A master lease agreement gives you the tenant control and management of a property for a set period, usually several years.
Oh.
You lease the entire property from the owner and then sublease it to individual tenants. So you're acting as the landlord without actually owning the property.
Interesting. It sounds like a way to leverage a property without that upfront cost of buying it.
It is.
Why would an owner agree to that?
There's a few reasons. They might be tired of managing the property themselves or maybe struggling to find tenants.
Okay.
A master lease provides them with that guaranteed stream of rental income and takes the burden of property management off their shoulders.
So it's about offering solutions.
Exactly.
As with the other creative financing techniques.
Like we were talking about before.
Right. Are there any potential pitfalls with master lease agreements?
A clearly defined contract is crucial,
Okay.
outlining each party's responsibilities, including rent payments, maintenance, and lease terms.
Got it.
Vetting the property and understanding those financial implications before signing is also essential.
Sounds like due diligence and legal guidance are must-haves.
Absolutely.
Speaking of putting in the work, what about sweat equity? How does that factor into creative financing?
So sweat equity is the value you create in a property through your own labor and effort, not cash.
Okay.
You're literally rolling up your sleeves and improving that property's value.
So it's like DIY meets real estate investing.
Exactly. It's a great way to leverage your skills and time, especially when cash is tight.
Okay.
You might negotiate a lower purchase price in exchange for renovating the property yourself.
So the seller gets a renovated property without paying contractors, and the buyer builds equity through their efforts.
Precisely. But remember, realistically assess your skills and your time commitment.
That's a good point.
Don't bite off more than you can chew, and always factor in material costs and any necessary permits.
Right. Great advice. It's about finding that sweet spot between ambition and what's realistically achievable.
It is.
We haven't talked much about specific property types. Are there any that lend themselves particularly well to creative financing?
Mobile homes are often overlooked, but they can be fantastic for those investors who are thinking outside the box.
Okay.
They're frequently undervalued, offer strong cash flow potential, and can be acquired with creative financing.
That's intriguing, but aren't there challenges with mobile homes?
There can be.
Yeah.
Perception plays a role, as they're not always seen as like desirable
Right.
as traditional homes, potentially impacting resale value.
Okay.
Financing can also be trickier, especially if the home isn't permanently attached to land.
So it's a niche market requiring some careful consideration.
It is.
What creative financing strategies are commonly used for mobile homes?
Seller financing is a popular choice,
Okay.
as traditional lenders can be hesitant with mobile homes.
Right.
Lease options are also viable,
Okay.
allowing that gradual progress toward ownership while building equity.
It's about finding ways to navigate those unique financing hurdles.
It is.
What about due diligence for mobile homes? Anything specific to look out for?
Thorough inspection is key,
Okay.
as is verifying that title status.
Right.
Also, understanding the regulations governing mobile homes in your area,
Okay.
as they can vary significantly.
So it's similar to traditional real estate, but with extra attention to the nuances of mobile home ownership.
Precisely.
Okay, now, let's not forget the tax implications of creative financing.
Yes.
It can offer advantages, but understanding them and consulting a tax professional is crucial.
Absolutely.
Right. Ah, yes, taxes can't escape those.
Can't escape them.
What are some potential tax benefits to keep in mind?
Depreciation is one.
Okay.
You can deduct a portion of a rental property's value each year to offset rental income,
Okay.
significantly reducing your tax liability.
So it's a tax break that acknowledges the wear and tear on your investment property.
Exactly. Another potential benefit is the 1031 exchange,
Okay.
which lets you defer capital gains taxes when selling an investment property and reinvesting the proceeds into a like-kind property.
That sounds that sounds like a fantastic way to keep that investment momentum going without a hefty tax bill.
It can be, but remember, tax laws are complex
Right.
and constantly changing.
Yeah.
A qualified tax advisor can guide you through the intricacies of creative financing and help you optimize that tax strategy.
Right. Taxes might be unavoidable, but with the right advice, we can make them work in our favor.
Absolutely.
We've talked about strategy, tactics, we've even talked about the legal side of things.
We have.
But what about the mental game?
Yeah.
How does mindset play into success with creative financing?
Mindset is absolutely crucial in real estate investing.
Oh.
Your attitude, your beliefs, your willingness to step outside your comfort zone can make all the difference.
So it's about embracing those challenges and seeing opportunities where others might just see roadblocks.
Precisely. Cultivate that growth mindset, be persistent, and don't be afraid to think differently.
I love that.
Creative financing rewards those who are willing to challenge that conventional wisdom and forge their own path.
That's inspiring. It's about looking beyond those limitations and seeing the potential that's out there.
It is.
This deep dive has been incredibly insightful, and I'm feeling ready to put these creative approaches into action.
That's fantastic to hear.
It really is. Thank you.
Remember, creative financing is about more than just the techniques.
Yeah,
It's a philosophy of empowerment.
that's so powerful.
It's about breaking free from those traditional financial constraints, building wealth on your own terms, and creating a legacy for yourself and your family.
Wow, that's a powerful vision.
It is.
It's about taking control of your financial destiny and shaping your future.
Exactly. Creative financing, with its flexibility and focus on problem solving, can be the key to unlocking that empowerment.
This has been an incredible exploration of creative financing.
It has.
I'm feeling energized and ready to dive into this world headfirst.
That's great.
What are some key takeaways our listeners should remember as they embark on their own creative financing journey?
Embrace those unconventional approaches. Stay curious, persistent, and never stop learning. The real estate world is full of possibilities for those who are willing to think outside the box and challenge that status quo. Remember, creative financing isn't just about finding those deals.
Right.
It's about finding those solutions that benefit everyone involved.
That's fantastic advice. Thank you for guiding us through this fascinating world.
It's been my pleasure to go out there and get creative.
Welcome back to the final part of our deep dive into creative real estate financing. I'm feeling pumped, ready to put all this knowledge into action.
Awesome.
What specific strategies can we really explore to make this work?
Well, let's revisit that BRRRR strategy.
Okay.
Buy, rehab, refinance, rent. A popular approach for building a real estate portfolio quickly.
Right. BRRR. We talked about the concept earlier, but I'm eager to hear more about the nuts and bolts.
Yeah, it's about leveraging those renovations to create that cash flowing asset. You start by finding a property that needs some work, something with good bones, but maybe outdated kitchens, bathrooms, landscaping, things that can boost value without a complete overhaul.
So it's about spotting those diamonds in the rough.
Exactly.
But once you've found that potential gem, what's next?
Then comes the exciting part, the rehab.
Oh, yeah.
Planning and executing those renovations efficiently is key to staying on budget and maximizing that return.
Got it. So no going overboard with fancy upgrades that might not actually translate into value.
Exactly. You want to strike that balance between making the property appealing to those renters while keeping those costs in check.
Right.
Once those renovations are complete, it's time to refinance.
Ah, the refinance. That's where the magic happens.
Yeah, a successful refinance based on the property's improved value allows you to pull out most, if not all, of your initial investment.
Okay.
This frees up your capital to BRRRR, another property.
So it's like a snowball effect. You start with one property and then the momentum builds from there. I imagine finding the right lender is crucial for this to work.
Absolutely. Building relationships with lenders who understand BRRR investing is a must.
Okay.
They can see the value you've created through those strategic renovations.
It's about having a lender who's on the same page as you, who gets the vision.
That's the vision.
Once the refinance is done, what's the final step in the BRRR process?
That's the fun part, finding good tenants and starting to generate that passive income.
So it's not just about flipping properties. It's about building long-term wealth through rental income.
Precisely. BRRR is a long game.
Okay.
It's a way to build that sustainable portfolio that generates cash flow for years to come.
But before you jump headfirst into BRRR, it's essential to understand the potential pitfalls,
Absolutely.
right? Every strategy has its challenges.
It does.
What are some common mistakes BRRR investors make?
Underestimating renovation costs or timelines is a big one.
Yeah, that makes sense.
Another is overestimating the property's after repair value, which can lead to those challenges with the refinance.
Okay.
And of course, choosing the wrong property in the first place can derail that entire strategy.
So it's about careful planning, research, and knowing what to look for in a property.
Yes, it is.
It sounds like BRRR is more than just a technique. It's a whole mindset.
That's a great way to put it. BRRR requires patience, discipline, and a solid understanding of the real estate market. But those rewards can be significant for those who approach it strategically.
This deep dive has given me so much to think about.
That's great.
It's not just about the specific techniques, but about expanding my perspective and embracing those unconventional approaches.
Yeah, I think that's the key takeaway I hope you walk away with. Creative real estate financing is about unlocking those possibilities that those traditional methods might miss.
Yeah.
It's about challenging assumptions and forging your own path to success.
I'm feeling inspired and empowered to get creative with my real estate investing.
That's fantastic. I'd love to hear that.
Thank you so much for sharing your expertise and insights.
It's been a pleasure. Remember, the real estate world is full of opportunities for those who are willing to think differently and take action.
I love that.
Good luck.
Thank you so much for joining us on this deep dive into creative real estate financing.
It's been my pleasure.
We hope you enjoyed this journey into the world of unconventional real estate investing.
Yeah.
Remember, with the right knowledge, the right mindset, and a willingness to think outside the box, you can achieve your real estate dreams.
You got it.
Happy investing.